Thank you. Okay. So we go to business chapter 26, cash flow forecasting. So when we talk about cash flow forecasting, cash itself is the coins, the money we spend, and it's the most liquid of all assets businesses do have. The flow, that means how it comes into the business, how it goes out of the business. The forecasting, the prediction about how money is going to go out of the business, how money is going to come into the business. So as a business, you need to predict what your expected revenue. You need to predict your expected expenditure. So that is what this is all about. Please scroll down. Thank you. Great. So they said cash is the most liquid of all businesses' assets. So we have other assets as a business. We have debtors, which is also part of a business asset, current asset. We have stock, which is the inventories in the business. It's also part of the asset. But the one that is easily can turn to cash, or that can easily be spent, is what we call cash, which is liquid. They call it liquid because it can be easily spent or converted into money. Do you get it? So they said cash is the most liquid of all businesses. Cash is notes and coins businesses keeps on the premises, and any money it has in the bank. That's the cash at bank and the cash at hand. They are all cash. In as much as you can spend it, it's money. Without cash, a business cannot trade. It is reckoned that poor cash flow is the reason why many businesses eventually fail. So without cash, businesses cannot transact. So most of the time, businesses do fail because they are unable to manage their cash. Do you get it? Mm-hmm. They are unable to what? Manage their cash. So that makes them to fail. Businesses. So even when trading conditions are good, businesses can fail. If a business does not have enough cash to pay its immediate bills, it cannot trade. Businesses need cash for the following reasons. So before going into the reasons for needing cash, even if everything is fine, in as much as you don't have cash, it becomes a problem. Because most of the time, people want to transact. People need physical cash. They need it. They need it to, like, they have them. If not, they might not want to even transact with you. Some will go to the extent of saying they don't want transfer. That they don't want transfer. They don't want you to credit the account. They want physical cash. Do we get it? Yes. So let's go to the reasons why businesses would need cash. Number one. Thank you. To pay suppliers, overheads, and employees. These ones are important. We need cash. Businesses need cash to pay their suppliers. Who are the suppliers? The businesses that they buy from. Maybe those that supply them with raw materials, those that supply their goods. You need to pay them. Yes or no? Yes. So you need cash to pay your suppliers. We already know who suppliers are. Those that supply to the business. Those that bring the raw materials, or those that bring us the goods that we sell. We need to pay them. One of the reasons for cash. Two, overheads. We're talking about the expenses. The running expenses of the business. Like maybe stationery, like electricity bills. All these things you have to pay them. Stationery, stamp, you have to pay them. Wages is part of employees. Let's talk about overheads. Overheads are your expenditures. Like stamp, like transportation, electricity, all these things have to be paid for. We need cash to pay for them. So overheads are your expenditures. These are office expenditures. We call them office expenditures. Office expenditures. Do you understand what overhead is now?
Yeah.
Employees. Why do we have to pay our workers too? Yes or no? If we don't pay them, are they going to stay with the business? No. Do we get it? So the first reason why we need cash is to pay employees, to pay for our office expenditures, and to pay for the suppliers who supply or who give us raw materials or goods that we sell. The second one, to prevent business failure. It said, if a business goes out of cash, it will become insolvent. When they say a business is insolvent, it means the business will be unable to pay its debts. That is what insolvent means. That means the inability of a business to be able to pay its debts. Do you understand what insolvent is?
Yes.
Do you want me to write it?
No.
Okay. So, if you don't have cash, you won't be able to pay your debts. And if you are unable to pay your debts, it's a problem. They will start dragging you. So business running out of cash makes the business to become insolvent. Won't be able to pay its debts. Is it clear? Is it clear, please?
Yeah.
So unfortunately, unless the business can raise cash immediately to pay the most pressing debt, the business will collapse. Therefore, it is important that the business continually monitors and controls its cash flow. The business will have better control over its cash flow if it's school on this. Yeah, thank you. So you need to have control over your cash flow. If not, you are running into debt. You won't be able to pay, then you become insolvent. But how are you going to be able to manage your cash flow? Number one, keep up to date records of financial transactions. So whatever transactions you have done, whatever you have sold, whatever you bought, keep records of them. So this gives you a track on what is coming in, what you have spent and what you have received. Two, always plan ahead by producing accurate cash flow forecasting or forecast. You always plan ahead, because when you plan, it means you've predicted that, oh, in the next 3-4 months, this is what we have to spend. In the next 3-4 months, this is what we are expecting in terms of cash. So you should plan ahead. If not, then you have problem with your cash. If not, you will spend out of your budget. You should have a budget. That is the plan. You should have a budget, a financial plan. If not, you run out of cash. The third one, operate an efficient credit control system which prevents slow or late payments. Yes, you could sell on credit, but make sure you are operating an efficient one. Keep track of your creditors or your debtors. Make sure they pay on time. And don't allow too much credit. That's credit control. You understand what credit control is here? Keep track of your debtors. Don't let them owe you for a long period of time. And do not allow so much debtors at every point in time. Don't let them get used to buying on credit, because it's not going to be good for your business. They take the goods out, money is not coming in. They have a cash flow problem, then the business might collapse. Is it clear?
Yes.
Any question up to now?
No.
We'll move on, please. Now, the difference between cash and profit. Cash is not profit. Cash is not what? Profit. Look at what they say. They say it is important to recognize that cash and profit are different. At the end of the trading period, the value of profit will not be the same as the cash balance. Some of the reasons for this are outlined below. So before we go into this, your cash balance is what you have in your cash flow, what is coming in and what is going out. It is not the profit. Your profit is your total revenue minus your total cost. Do you get it?
Yes.
Your cash balance is the value of what you have in terms of cash in hand or cash at bank. That's your cash balance. The money you have, that is not the profit. Profit is a separate thing. So, one, it says some goods are sold on credit, trade payables. So at the end of the period, some customers will still owe money. Therefore, profit is greater than cash. Look at it here. Why is profit greater than cash? Profit is greater than cash because sometimes you sell on credit. Yes or no? So they are owing you. They've not paid. But you're still going to get that cash. It's going to be part of your cash balance. Do you get it? You've sold it. It represents cash that is coming into the business, but it's not there at this point in time. Similarly, business will receive cash at the beginning of the trading period from credit sales made in the previous period. This will increase the cash balance but not affect profit. You might, for the last year, some customers are owing you, they pay this year. It improves your cash balance, but does not increase your profits. Do you get it?
Yes.
Yeah, your cash balance increases, but does not increase your profit, because you would have understood that your profit is your total revenue minus your cost. So your cash might increase, but does not necessarily mean that your profit is increasing. That is the point. Do you get it?
Yes.
The second one. Sometimes owners might put more cash into the business as capital. This will increase the cash balance but have no effect in the profit made. The effect will be the same if a business borrows some money. So owners of a business might add money to the business. That increases the cash balance. The owner of the business has injected cash into the business. But the owner of the business is not injecting profit. Profit will be made based on your sales and your cost. But your cash balance will improve. Same goes to when the business takes or borrow money. So a business might borrow money, yes. It does not take away its profit. But it's going to affect what?
The cash.
The cash. Do we understand? Do we understand this?
Yes.
The third one. Purchase of fixed assets such as machinery or equipment will reduce cash balances but have no effect on the profit of the company makes. This is because the purchase of assets is not included for the purpose of calculating profit. We said profit is made as a result of sales. Yes or no? So profit is made as a result of sales. So if I'm buying an equipment, if I'm buying a machine, it's not going to affect my profit because I'm not buying that machine as a result of wanting to sell it. I'm buying it to use for the business. So it will affect the cash because you would have taken cash to purchase that asset, but it's not going to affect your profit. Do you get the point? Purchase of assets would affect your cash balance, but would never affect your profit. Same goes to capital injected or cash injected into the business. Cash injected into the business will affect your cash balance by increasing it, but will not affect your profit.
But if you buy more machines, you start producing more.
Yes.
So you're selling more.
Yes.
So gaining more profit.
Okay.
So it affects your profit at the end.
No. In the first instance, the point is that we are buying equipment. What happens to our cash? Cash will reduce in place of assets. But whatever you do with that equipment will come from sales, not cash. Whatever you do with the equipment you bought, you use it in producing, right? So you produce stocks, you produce goods, you are going to sell them. Profit will come when you are thinking about sales, not when you purchase equipment. That is the point. Do you get it?
Okay.
There's those equipment you bought, you're going to use them to produce. And because of producing more revenue for the business. And when your revenue exceeds your cost, you make profit. But that is after thinking about sales, not thinking about purchasing assets. So we're talking about thinking about purchasing assets here. When you think about purchasing assets, it's not going to affect your profit, it will only affect your cash balance. Look at what they said. They said, but have no effect on the profit a company makes. This is because purchase of assets is not included for the purpose of calculating profit. You purchase assets, you are not selling it. You want to use it to produce. So when you start producing, then you can think about making profit. Clear? The amount of cash at the end of the period will be different from profit because at the beginning of the year, the cash balance is unlikely to be zero. You can't start the year with zero balance. Do you get it? You can't start your financial year with zero balance. You start it with some figures. You get my point? So at the end of it all, the profit we make will be different from the cash balance.